Hey, I'm Andreas Steno from Real Vision, and this is the daily briefing. We are sending to you live Thursday, the 25th of August, after another week of absolute mayhem in energy markets. So today we're going to ask the question whether there is any light at the end of the energy tunnel, and I guess no one's better equipped of answering that question than my guest today, Tony Greer, the founder of TG Macro. It's very good to see you again, Tony.
Too kind of you, Andreas. Great to see you too, man. How you doing?
All good. Just back from Turkey, actually. But I wanted to ask you initially, Tony, what's been on your radar in the past trading days here? It seems as if energy is on top of everyone's agenda again.
Yeah, it sure is. It sure is. We just pounded the 2021 highs at $86 when WTI pulled back to its low around $86. And, that was a level that we kind of expected to hold technically because the entire physical market has been very strong. So when we held that level and then a couple of days later, Prince Abdulaziz, Saudi Arabia's, representative in OPEC, came out and said that basically that he doesn't appreciate the severe disconnect between paper and physical markets, which he's basically calling somebody out, i.e., the United States, potentially for manipulating the oil paper markets, which seems something that's highly likely and is being timely done for political purposes with elections coming up in November, like everything else that we're seeing. And I think that Prince Abdulaziz comment that if he's continued to see this, that the OPEC would in fact cut output to me, and then see crude oil rally, over a couple of days to a high of around 95 and a half, $96. That's the signal to me that that dip is over, and it really is. I mean, we've really had everybody pounding the downside, looking for to follow in on this recession story. And now you've got break evens bouncing off of the lows of their move, and the curve bouncing a little bit off of the lows. We got a sort of weak number today in GDP, another quarter of negative GDP growth, and yields didn't budge from the highs. So I thought that was interesting. I feel like the bond market is, focusing on commodity inflation and not as much on the pending recession like it was a couple of weeks ago. And it feels to me like the next $10 or $15 higher the next $10 to $15 in crude oil is going to be higher again because there's simply no inventory anywhere. And the spreads have just been knocked all the way back to, 30, 40, 50 cents backwardated per month. And, that's where they had been trading in a normal backwardated market before things went crazy during the Russia-Ukraine invasion. And, the spreads per month blew out to $3 and $4. So that's the situation on our hands right now, Andreas. That crude oil today failed at the highs at the 200-day moving average resistance level, something to be totally expected the first time up there. But I'm pretty sure next time up it's going to go through because we are running out of room and time to get this much lower on the downside. So it feels to me like we're going to have to test the upside in the next couple of days. What do you think?
Well, I tend to agree on the short-term outlook, and I have to give you my compliments here, Tony. You remained very calm during this bearish price action that we saw in crude oil through July and parts of August. So well played. In terms of today's overall question, Tony, is there any light on sort of the supply side of the energy question? What's your take on that? Do you sense any light at all right now?
I really don't, I really don't. And when I take a step back and read some notes and some pieces that look at the world from 30,000 feet up and go over the lack of and continued diminishing investment in, drilling and exploration and production in oil, it's not going to be until we reverse that oil prices will really be able to move much lower for any kind of an extended basis. And when I look at the timeline now, Andreas, I look at the fact that the US just sent another $3 billion to the Ukraine, and a lot of military assistance, and some of it is kind of spread out the calendar. as in they're not going to be sending stuff, until 2023 and 2024 and 2025. So I'm trying to understand how, an oil bear is going to look at this and say, well, we're going to be in a prolonged conflict now, assisting the Ukraine versus Russia. How in the world is the oil price going to stay close to 90? And that's what I'm trying to figure out right now. And to me, the answer seems like it's not going to, because now the oil market feels fairly balanced between, trading on either side of 90. And now we've got any one of 1,000 supply disruptions or, kind of bullish episodes that we can live through heading into winter. So, that's what leads me to believe that the downside is limited right now, and that I'm going to continue to play for the upside, especially after having, lived through this attack where all of the energy equity names all pulled back to their really steep pullback to their 200-day moving average support, kind of the last lines of support for technicians. And it looked scary down there, but it held the whole way. The story was in the fact that there was no spare capacity out of Saudi Arabia, limited inventories, and really no spec long to be flushed out of the markets. So, I'm getting fairly constructive again, Andreas. I don't think that I'm kind of the in the camp where the fears of a recession are maybe exaggerated a little bit. And, we'll see what happens to gasoline demand. But right now it seems to be hanging fairly firm. We just got another big draw in WTI this week that kind of helped to test the upward bound of the range there. And I feel like that market is fairly healthy and looking to go higher. But no, I don't see any end in sight to the war on supply that we're seeing right now. They're still trying to push people toward electric vehicles. I mean, that's what the whole entire Inflation Reduction Act was about. It's got nothing to do with, reducing inflation. It's all about, offering incentives to change people's energy consumption habits. And so the only savings in there is if you go in and buy some solar panels, you get a tax credit. And if you go in and, more efficiently, heat your home or cool your home, then you get a credit for that. So, I don't know how all that stuff is going to pan out. And we continue to hit the spending button as often as we can. And the Biden administration and all of that seems to be continually inflationary to me, but we'll see.
Yeah, it's certainly not an Inflation Reduction Act. Maybe
Right?
rather the opposite. But
Exactly.
Tony, you briefly touched upon the positioning, and I think we can bring up a chart on the positioning
Yeah.
across various commodity markets. There is a net long position in the oil market, for example, but it seems as if you look beneath the surface, that the traded volumes are getting lower and lower. So speak to this positioning and whether it's something that worries you in your long bet on energy.
It really doesn't, Andreas. I've seen the oil market with, spec positions of 500 and 600,000 contracts long. And I've still seen it go up with that carry that much length higher when the market is physically strong. I still think that that's kind of a situation where we are now. I don't think that the spec length is bloated enough where, it's going to tip the calendar back over from these prices to into contango, certainly, because that's what we're talking about now, right? And I don't see, if you look at where inventory levels are at Cushing and in some of the other pads, in some of the products, you can't imagine how spreads could possibly go contango with the amount of inventory that's there. So we're nowhere near that floating storage trade. We're not going contango with the amount of supply that's out there. And I think it's just a matter of time before tightness works its way back in, and we see, like I said, one of any 1,000 types of supply disruptions that we've been seeing over the last several years.
Tony, if we look at the situation in the natural gas market, I think we remain within spitting distance of highs in the natural gas price in the US, and certainly so as well in the European Union. What's your take on natural gas in relation to the oil story?
It doesn't seem like anyone in Europe has a plan,
No.
Andreas, right? For what they're gonna do next. And I just tweeted that out yesterday when natural gas prices hit a new high. Today they traded to Dutch TTF traded up to 91 or $93. It settled per megawatt hour. Put it this way, there's a couple things weighing on that. Positioning in natural Jared Gillian seems to think that there's a lot of assholes in the natural gas trade, which there may be. And I'm definitely going to heed that call, because the last time he made a call like that in energy, oil fell $30 in a straight line. So no matter what, I'm going to keep my eyes peeled for that. But at the same time, it still feels, like I said, with there being no plan, um, I don't know what's going to reverse this right now. It feels like very sort of spookily related to Macron's recent comment about the end of abundance in Europe. And, he must clearly be talking about the end of abundance of food in Europe, as the Netherlands plans to close down thousands of farms to, improve their ESG score. And that's going to take a lot of food off a lot of tables. The price of natural gas going higher is not helping the issue at all. They're still entirely beholden to Russia right now, who seems to be, turning the tap on and off at his whim. And we'll see how it continues from here. But I don't even think that we've reached the main event as sort of the point of max pain that Europe is going to see before this is over. Do you?
Well, I think it's tricky right now. I mean, we can all agree that Europe is stuck in a huge mess.
Yeah.
But if we look at the current storage situation in Europe, it actually seems as if most European countries are at least slightly ahead of the curve in terms of filling up natural gas storages. But I mean, there is obviously a big difference between the stock and the flow in this discussion, and the flow is still not super good. So it is an issue that we will continue to deal with in Europe throughout the winter. Um, I personally think that we will peak at some point during the fourth quarter, but it's very, very tricky to time it. And I'm certainly not trying to bet on it right now, because, I mean, you can just, basically destroy your portfolio before you get the timing right. But if you look at the discussion on the storage situation in Europe, would it be something that you could take comfort in, or are you still worried about the issues surrounding the energy complex in Europe heading into the winter?
Well, I've seen you very astutely point out that their storage is a little bit better than the sort of narrative will allow, and I can
Mm,
appreciate that certainly. I do think that it is going, the price is going to peak out some point before, I don't know, before sort of hell freezes over there, right? I think that you'll
mm,
see a peak in the prices sort of late in the fall, when everybody is so geared up about this, and then there'll be some kind of a political response to manage the optics,
mm.
which has kind of been the back and forth that we're seeing. Gas goes to $5. Biden releases the SPR, gas goes to $4. They take a victory lap. They add gas prices going down into the sort of campaign slogans for November, and things like that. And so, all of this is really tricky into November, and that's happens to also be where the SPR releases are scheduled out to. So if they don't renew any more SPR releases for after the election, which may be a point that they're going to let the political optics get a little bit ugly again, um, oil is going to go straight to $125 again,
Mm.
right? Because that's basically the SPR releases have been what have been stopping it from going there several times over the last few months. And then we ran into that whole recessionary scenario that really, put a real damper on demand and demand growth expectations. But still that is sort of the where the rubber meets the road in the oil market right there.
We've seen a few announcements, for example, in Switzerland, that public buildings will use heating oil instead of natural gas as sort of the heating source for this winter. Do you have your eyes on the heating oil trade potentially, Tony?
Yeah, I just have my ears out for that, Andreas,
Mm,
because that's the sort of switchover that becomes bullish WTI side of the trade,
mm.
right? And as you know, we're already pretty tight on inventories across all products in terms of diesel, gas oil, heating oil, everything is tight across the board. So yeah, I mean, it seems like that is, that would be a natural switch over to go to that. And, prices there are still on the rise and inventories are still tight. So, what that does is that helps me a little bit, quite a bit, Andreas, because I have a lot more risk in crude oil than I do in sort of natural gas risk. Like, I'm old enough to remember how many times I've gotten burned being long natural gas, looking for the moon and the stars. And, I would rather sort of play natural gas at the $5 table, if you will, and you know, have a little bit of risk on there and a little bit of risk in the stocks, and sort of play the WTI trade from the Peacock Lounge, which is sort of the high rollers table where you can bet, you know, $2,000 or $3,000 a hand in blackjack, or $10,000 without raising an eyebrow. And so that's kind of the way that I've been lining up my energy bets. And so holding that dip there in energy was huge. And I'm coming out the other side looking to play offense.
Mm. If we look at the price action in metals, Tony, we've seen a small rebound in, for example, the copper price over the past, say, 4 to 6 weeks. What do you make of the price actions within that space?
Well, we got a super steep slide in copper, you know, as we priced in that
Mm,
recession again, not to be too repetitive. I'm
mm,
sorry, but it's part of the story here. Once again, we hold the old lows in copper, or excuse me, the old highs in copper as support. While we do that, break evens bottom out at 2.75 or 2.73% in 5-year break evens. And, you know, those are obviously forward looking inflation expectation, market based inflation expectations. And then break evens held because we kind of overshot the economic weakness on the downside. They rallied out of the hole. The curve stopped going down finally. And so whoever got short copper into the lows had to run out and cover. So, and I still think that the you know, broad supply demand fundamentals in copper are still pretty bullish. At least, you know, they may not be 12K LME bullish, but 7, 8K on the LME certainly seems like more than a fair price for the direction that we're going to go with the electronic vehicles and how much copper we're going to need for sure, for that transition. And then for any, you know, stabilization in the economy is probably also going to put some demand back into copper. So hard to get bearish copper after 40% sell off, right?
mm. Tend to agree. I wanted to play a soundbite for you, Tony, in relation to the debate on whether to add exposure in metals to a portfolio. It's from a discussion between Adrian Day and Larry McDonnell. So let's listen to the soundbite and get back to that discussion, Tony.
So the point I'm making is that copper, to me, has very, very powerful supply-demand dynamics, even if you ignore the electrification of the grid and the electrification of the automobiles. And part of it is not just the demand, but it's also the supply. There are some commodities where people talk about shortages. And of course, the shortage doesn't really exist. It's a matter of a shortage at a particular price. But there are some commodities where there's a current shortage, but there's not a shortage of capacity. So you could increase the supply if you wanted to. Copper is not in that case. In the case of copper, you know, copper mines, as we mentioned earlier, are huge. They're big. They're huge investments, $500 million or $1 billion or even more than $1 billion. The point I'm making is that it takes a long time to develop a major new copper mine, right? Freeport recently said that they have put all new mines on hold for the time being. And they were asked a question, they were asked a question about how long it would take them to bring new mines on board, and they said even the shovel ready, where they already have the permits in place, would take 5 years before it starts producing.
The entire interview is available for Essential Plus and Pro subscribers to Real Vision already today. Tony, back to you. A very compelling storytelling on the lack of supply also within the metal space. Do you see a fit in your portfolio for being long metals right now?
Yeah, we're long metals and mining at TG Macro on the Navigator. We bought XME on the dip, you know, into support there. After having a long run in it from the long side and getting out higher, we got a chance to buy it back, so we did. I'm kind of keyed up on the fact that you know, I don't think it's necessarily the right idea to throw in the towel on commodities broadly and metals and mining very specifically heading into a stagflationary type of environment like I think we're seeing. I just read a couple of different reports that were really, really compelling. One of them by Gehring and Rosenschwag, I believe is the pronunciation of the second partner's name in that firm. They put out some really, really thoughtful research in energy, and they go back to the 70s and 80s, where we saw a lot of inflation and we suffered a lot of recessions during that period of time. And during that period of time, a portfolio in metals and mining, gold miners, mostly natural resources, dramatically outperformed the S&P, believe it or not. So that's the kind of scenario that I think that we're looking at now, where we're going to have fits and starts in the commodity, and excuse me, fits and starts in the economy. It's certainly not going to be a one-way train of improvement with the way the world is changing, and the path won't be linear to higher commodities. But we are set up right now for extremely tight situations across so much of the commodity complex that it feels like one of those scenarios where we're coming out of 2 decades where everyone had to be positioned for deflation to make money. And, these were the stocks that were left, kind of left forgotten about. And it feels to me like, we are actually slowly peeling out of that, and natural resources are becoming a little bit more and more of, people are recognizing that they've been left for dead for a long time. They're an extremely small portion of the S&P. And, it might be the type of period for the next 10 to 15 to 20 years where hard assets are probably a good asset to have on your pad. So yeah, we're set up for it. I'm hoping that the last dip was, you can pretty much explain that XME path through the narrative. It got going on, the push to electronic vehicles. It got a little bit out of control where we had the commodity rally, and crude oil traded higher. And then we backed off into support just now on the economic softness, and it held like a charm again. And buyers come back in, the market's not excessively speculatively long, and it gets back on its feet. So those are the types of trades that I'm looking to continue to happen. And that's what I'm going to keep chasing in the commodity sector for the rest of the year, Andreas, if that's fair.
Yeah, it is. I have a structural allocation towards the metals and miners in my structural portfolio as well, and I'm basically not touching it.
Yeah.
Let me put it like that. Speaking of equities, Tony, we've actually had a decent day in U.S. equities. If you're right that recession risks are maybe sort of exaggerated by now, would you then be on the long side, generally speaking, in terms of equities?
Yeah, I just had a short period of time there where our book was long only for a couple of weeks, where we covered our shorts very close to the lows in technology and retail. Rode the book long only for quite a bit, and just started pivoting into a couple of short positions, i.e. in home builders. But broadly speaking, I think for now the tape might be in a bit of a range between now and the end of the year. I do think that we're going to take one more look at the low or somewhere close to it. But I don't think that path is going to be linear either, because I think that we're going to be fighting the Fed the whole way. Even though they're trying to pivot and stay hawkish to fight this inflation, especially for optics sake, their tendency is to want to sort of lay back off the gas, as you know. And I feel like they're kind of just looking for that excuse so that the S&P can get back on its feet and start rallying again. So that's something that I don't really like to bet against. But for now, I feel like the S&P is set up with some severe challenges ahead for the next couple of years. So I think it's most important to be in the right sectors.
Yeah. So what are your top picks right now in terms of sectors, Tony?
Man, I'm a little bit of a broken record right now. I'll tell you, Andreas, I'm still in all commodities all the time. Right now, we've got, I'm in the natural resources trade. I'm in the natural resources ETF, IGE. There are a lot of refiners in that, and refiners are currently galloping higher to new highs for the current move. I think that's really important. I think that speaks to the profitability that they just kind of revealed in the last earnings season, where, whether the crack spread is $30 or $40 or $50, it's a small windfall for a lot of the refiners out there. And I think that they, continue to sort of under promise and over deliver on the actual earnings side. So I got a feeling that we might be set up for quite a run for them. And that's what keeps me bullish in the natural resources space. Once again, if this natural gas main event is going to happen in Europe and we're going to get a serious rally here, I think it makes sense to be in the ags for sure for the rest of the year in some capacity. I think the fertilizer stocks and even the food producers are a good place to be. And I'm just trying to avoid technology, as you can see, it has not been performing well in a period of rising interest rates and headline inflation. You look at today's rally, Andreas, and the three leading sectors on the top of my or the four leading sectors on the top of my selfish leaderboard are cannabis, social media, semis, and internet stocks. Right. And then you look at them year to date and they are down 48%, down 38%, down 24%, and down 35% year to date. So as long as the sort of retracement rallies have this type of leadership here, I'm not going to get too caught up in where the S&P might be headed right now. So that's kind of my look at what's going on. I am still looking for natural resources to sort of hang in there and continue to perform, even if the S&P backs off.
We have a question from Piers in relation to the energy trade, Tony. He asks you whether the gas and electricity shortages will mean that Europe will be headed for a severe recession this winter, and whether it will ultimately imply meaningful demand destruction that could also tilt the long energy trade.
I mean, the euro and the headlines are trading like it is a controlled demolition scenario, right? It's really it's upsetting to me to see. I can imagine what it would be like if you lived in Berlin or Hamburg or something like that, and you've got officials telling you to stock up on firewood and use washcloths instead of taking long showers and things, and you're trying to prepare for this in your life. And, you've got Macron over here saying that we're at a period where at the end of abundance and everybody's going to have to make sacrifices. I don't know. It just doesn't look good for Europe. And when I definitely wanted to get back to this, when I tweeted yesterday with natural gas prices trading to a new high, like, does anybody in Europe have a plan? And the reality is, if you pay close attention politically, the answer is no. They are absolutely not prepared for natural gas prices to continue higher. They're not prepared for food shortages. They're not prepared for a very cold winter. And, you even hear some of the, more sober officials finally warning about that, right? And that they're finally, admitting that they may be in for some unrest and some pretty ugly headlines ahead. And I feel like, that's, that the sign is up on the marquee and the people are waiting on the popcorn line for that movie to take place, because the writing is on the wall there. If we get a cold winter in Europe, they're in for hell. So, as much as I hate to see it, and as much as I believe in your idea that they are doing a lot better, filling up storage, to a higher percentage of capacity, it doesn't matter if, they're still one cold spell away from being at risk. Even if they have a normal amount of gas in storage. So it doesn't ease my concern heading into the winter that, they're doing okay on storage, because if it gets very cold and Putin decides to say 6 weeks of maintenance on the Nord Stream, they have a huge problem on their hands, right? Huge. So as long as they continue to push him, militarily, he's going to have that lever to pull politically. And man, that's a really powerful one. It doesn't seem like it against the military might, but it sure is a powerful lever to pull.
Yeah. And I mean, even if Europe sort of manages to get the flow needed in natural gas, they would have paid a price that is so much higher than usual. So in any case, it's a bad scenario, right? Even if the flow is strong, it's being paid for with activity basically by the end of the day, because of the huge increase in the price. So I think a recession is simply a done deal in Europe. It's just a matter of how deep a recession that we're going to face this winter. Tony, it's been a great pleasure to interview you again today. Any final remarks for the audience?
It's tough to get your bearings on the world, on a kind of slow, doldrums of summer. But I'm kind of paying attention to the statements that I'm hearing right now. And, I think that if you're in the oil markets and you're not really focused on that Prince Abdulaziz statement, go back into Bloomberg and listen to the interview and, understand that these people are very serious about standing their ground in terms of their energy positions. And when they're selling cargoes, physical cargoes at, prices above the spot price, to Asian clients, and they see the U.S. paper markets get trashed at 8 o'clock in the morning on the open, they're very wise to what's going on. And if they decide that they're going to put some reverse pressure on the wise guy that's knocking the price of oil down, well, then, man, then you can forget about, what's going to happen on the upside. So, that I think is the real risk in oil right now. And, that Macron comment about the end of abundance, man, he's still getting a lot of coaching from his Davos crowd buddies, and it doesn't sound like they're saying, look, in the event that natural gas goes completely berserk, what we're going to do is ease up some of these right? Like, nobody is making any sensible comments like that to prepare for a disaster. So, all they would have to do is go back on their heels on some of their policy, and we would be through a lot of these issues. So, until I see that, it's really hard for me to think anything is going to happen. Then we are going to have that really ugly main event.
We should come up with a short Davos ETF, Tony. I want to buy that so bad.
Yeah, totally.
I've made it my trademark to always conclude the discussion with a meme in the daily briefing. And today's meme obviously relates to the discussion we've had on energy. So I think we are currently in a damned if you do, damned if you don't scenario in Europe. Either the politicians can keep buying natural gas at unpayable prices, forcing a recession, or else they can ration energy, forcing a recession anyway. So there is no good solution to this after years of bad policy, basically.
Very, very well laid out, Andreas. Yeah. Very well laid out. The meme always does the trick, right?
Yeah, it does. Tony, a pleasure to interview you again today. Thank you for joining.
Yeah, man. Great job, Andreas. Really great job. Thank you very much for letting us hash out these markets, man.
My colleague Maggie Lake will be back tomorrow with Jim Bianco, obviously with all the action from the Jackson Hole conference. So thanks for watching today, and see you again tomorrow.
Awesome. Cheers, Andreas.